Have you tried everything and still found no real solution? If that's the case, the new minutes will be a game changer. Keep on watching.
Real estate with realtor Kashif Sohail. Welcome to Washington America Show with international multimedia journalist, multidimensional, multifaceted artist and director of Human Rights Justice Council USA, Dr. Kashif Sohail.
In addition to monthly payments of taxes and insurance into a reserve account, the borrower must also pay a monthly portion of the principal, or amount borrowed, and interest on the principal. Collectively, all these portions make up the total monthly loan payment. The total monthly payment is referred to as the PITI, or principal, interest, taxes, and insurance.
Equity is the cash value of property after deducting all debts. Usually, an owner's equity is the monetary interest she retains over and above the mortgage indebtedness. For example, a buyer purchases a house for $100,000 with a $20,000 down payment and an $80,000 mortgage. The owner's equity in this house is $20,000. 10 years later, the owner sells the house for $150,000. Over the 10-year period, she has paid down her mortgage amount by $40,000, leaving $40,000 owed on the original loan. This owner's equity, or cash value in the house, is now $110,000, $20,000 original equity plus $40,000 loan reduction plus $50,000 appreciation equals $110,000.
A home equity loan uses a home's equity to secure additional borrowed funds. Home equity loans, or equity mortgages, are often set up as a line of credit commonly referred to as an open mortgage. The homeowner may borrow against this line of credit as needed, up to a certain amount. The interest rate is usually tied to the prime rate and, although it is higher than the interest rate charged on most first mortgages, it is much lower than the rate of interest charged for money borrowed through a credit card. For this reason, many homeowners use equity loans to consolidate consumer debt, or to finance repairs and improvements on a home.
A reduction certificate is a document that certifies the status of a loan. It states the amount of the loan that remains outstanding, the interest rate of the loan, and the date the loan matures. Mortgages must generally furnish a reduction certificate to prospective purchasers when they assume payments of a loan or take title subject to an existing loan. As a result, the purchaser is assured of exactly what is owed on the loan as of a certain date.
In a straight mortgage, only the interest is paid during the life of the loan. The full principal payment is due at the end of the term. Also called an interest-only or term loan, these types of loans were the only home loans available prior to the 1930s. After the Depression, lenders began using amortized loans.
A fully amortized mortgage is a systematic method to repay a loan by making regular, equal repayments, usually monthly, so that the loan itself, and all interest on the loan, is reduced to zero by the loan's maturity. Although the amount of each payment remains the same over the life of the loan, the amount of monthly interest and principal fluctuates.
A partially amortized mortgage is a mortgage with a series of amortized payments, followed by a balloon payment at maturity. The balloon payment is the entire remaining balance. A partially amortized mortgage provides reduced monthly payments at the cost of a balloon payment at the end of the loan's term, which is larger than any previous payment. For example, Mr. Ali wants to borrow $60,000 to open a small convenience store in a rural community. The local banks only loan money for 7 years on such projects. However, a fully amortized 7-year loan would require payments much higher than Mr. Ali could afford. Because the bank determines that Mr. Ali poses little risk of defaulting on the loan, it agrees to loan Mr. Ali the money for 7 years using a 20-year amortization table. This means that Mr. Ali's monthly payments will be much lower, but he will have a large final payment when the loan becomes due in 7 years.
Negative amortization occurs when the loan payments are insufficient to repay the interest. Such payments only cover that portion of the interest and none of the principal. Therefore, the loan balance increases rather than decreasing over the life of the loan.
A balloon mortgage is a mortgage in which the final payment is larger than any previous payment. The payment amount balloons on the last installment. Balloon financing permits lower monthly payments than fully amortized loans, at the cost of a final large payment at the end of the loan's term.
An ARM is a loan that allows interest rates to float up or down according to a specified index. The interest rate is adjusted at certain time intervals, such as 6 months or 1 year, usually having a cap rate or maximum rate of change, such as 1% or 4%.
A graduated payment mortgage is a mortgage in which payments begin low, but gradually increase over the life of the loan. A blanket mortgage is a loan wherein the borrower pledges more than one parcel of real estate as collateral for the debt. Blanket mortgages usually contain a partial release clause, which allows an individual parcel to be released when a certain amount of the loan has been repaid. Builders and developers commonly use this type of mortgage to develop large tracts of land that will later be divided into individual parcels.
An open-end mortgage is similar to an open line of credit. There is a maximum amount that one can borrow, but the borrower does not borrow all the money at one time. Also, the borrower only pays interest on the actual amount borrowed. This kind of mortgage is used for construction loans where the builder borrows money as portions of the project are completed. Another example of an open-end mortgage is an equity line of credit.
A package mortgage is a mortgage wherein the borrower pledges personal as well as real property. For example, a home loan that includes the washer, dryer, and refrigerator as collateral is a package mortgage.
A renegotiable rate mortgage is a long-term loan with short-term renewal periods, such as 3 to 5 years, and adjustable interest rates. The long-term mortgage amount remains the same and the mortgager has the option to renew. A reverse annuity mortgage allows elderly homeowners to receive monthly payments to meet living costs. They do so by borrowing on home equity. The homeowner receives periodic payments based on accumulated equity. The balance of a RAM, which never exceeds the value of the home, becomes due upon a specified occurrence like death of the borrower or sale of the home.
With a shared appreciation mortgage, the lender loans money at rates below the current market interest rate in return for a share of the profit when the property is sold. In other words, the lender shares in the future appreciation of the property. The specific terms of the shared appreciation agreement must be clearly stated in the mortgage or DOT and in the note documents.
A junior mortgage is any mortgage that is subordinate to a first, or prior, mortgage. In the event of a borrower's default, the first mortgage lender has a superior claim on the collateral, real estate, to satisfy the outstanding debt. Junior mortgages usually carry higher interest rates because they entail greater risk. Equity loans are usually junior mortgages.
A wraparound mortgage is a new mortgage whose balance includes not only the money borrowed, but also the balance owed on an older, already existing mortgage. In this instance, the older mortgage is not paid off, but the new mortgage wraps around the older one, producing a single payment to satisfy both loans. The new mortgage is junior to the older one. The borrower pays the new lender and the new lender makes payments on the original loan. In this way, the new lender can protect his junior position.
A purchase money mortgage, also known as seller or owner financing, is a loan by the seller to a buyer who usually cannot qualify for an institutional mortgage at the full purchase amount. The buyer often combines a purchase money mortgage with an institutional mortgage.
Conventional loans are not insured or guaranteed by the government like FHA and VA loans are. They represent a higher risk to the lender. Conventional lenders can reduce their risk by using private mortgage insurance, PMI. In many cases, private mortgage insurance also allows the lender to loan more than a standard 80% loan-to-value ratio. For loans requiring PMI, the lender charges the borrower an insurance premium that is due at closing, plus a small charge every year that the insurance is in force. Often, the borrower may terminate the coverage once the loan-to-value ratio drops to an acceptable percentage, usually 80%. Lenders must automatically cancel PMI coverage, on most loans, once the borrower reduces his mortgage to 78% of the value, 77% for high-risk loans, regardless of whether the borrower so requests. For example, Mortgage Guarantee Insurance Corporation, the largest private mortgage insurance company, insures the top 10% to 30% of the principal on loans made to qualified buyers. Because of federal regulations, ABCS&L is only allowed to make loans based on 80% of the appraised value. A residence is appraised at $100,000, but the buyer can only make a $10,000 down payment. By insuring the top 10% of principal loan amount with a MGIC insurance guarantee, ABCS&L is able to make a $90,000, 90%. loan without violating federal regulations. 80% is secured by the property, the top 10% is secured by the MGIC guarantee. Conventional mortgage lenders include mortgage companies, S&Ls, commercial banks, and private individuals.
Thanks for watching, and don't forget to click the link below in order to find out more.
Please share this video, subscribe to our channel.
Are you looking to buy or sell a home anytime soon? If so, you've come to the right place. We'd like to give you the opportunity to work with one of the top local real estate agents and get the best deal when buying or selling a home. The fact is, experienced agents can often get you a 2 to 10% better deal on the purchase or sale of a property, mostly due to their experience in the local marketplace and their ability to negotiate the best deal. So contact our top agent now and start the process of buying or selling your home.